Friends, this is Rahul here as the Chief Executive Officer of Treasury Consulting LLP, and today we would be covering a video on hedge accounting, rebalancing the hedge ratio. You know that hedge accounting is getting very relevant nowadays. In fact, it was relevant when we were having US GAAP. It is not that US GAAP is getting discontinued; it is still there. In US GAAP 157, which is fair valuation, and 133, which is financial derivatives, both has given a special emphasis to hedge accounting. But now IAS 39, International Accounting Standard 39, and IAS 32, they are getting discontinued, and it is getting slowly it is getting replaced by IFRS. But IFRS has made several things. First of all, it is a principle based. IFRS is principle based. On the other hand, US GAAP is a rule based. Of course, there are a lot of people we have across the globe who tend to disagree with this. There are people who agree with this US GAAP. There are people who agree with the IFRS. I personally agree with the IFRS. In my personal opinion, IFRS is much better than US GAAP. Of course, market is changing very fast. Since the market is changing very fast, we need to make a lot of changes in our business also. So such changes are also required in the IFRS 9 also. But till now, my personal viewpoint is that IFRS 9 is much better than we have US GAAP. Now, if you carefully see that the topic of the title today is hedge accounting, rebalancing the hedge ratio. Now, hedge ratio is getting very relevant importance in IFRS 9. What is the definition of the hedge ratio? Hedge ratio is hedged by exposure. If I speak in hardcore IFRS 9 language, then this is derivatives by exposure. Exposure means hedged item. If I simplistically refer, which is derivative to exposure. Exposure means hedged item. Because I was acting as a corporate treasurer, in our corporate language we always refer word exposure, right? Now, how you measure hedge effectiveness testing? Of course, there are two ways: quantitative and qualitative. IFRS 9 is more focused on quantitative than on the qualitative. However, US GAAP is more focused on qualitative than quantitative. Of course, there are few disconnects we have in IFRS 9 pertaining to the hedge accounting of the fair value hedging. I personally wrote a letter to FSB whereby I seek their help. I seek their attention in that regard. Let me see if this would happen or not. Both qualitative and quantitative have following methods like dollar offset method, long haul method, regression method, and hypothetical method. These are quantitative. While shortcut method and critical terms match method, they are qualitative in nature. I'm not here to explain how these methods look like, how these methods are going, but just what I wanted to tell you. Once you take a hedge, why you take a hedge? You take a hedge to cover either of this, which is cash flow risk, interest rate risk, basis risk, or credit risk. Now, you must be surprising that why I mentioned credit risk at the last. This is order of importance also. Majority or order of importance. Like if today you will take a, I would say not an interview, I would take you go ahead with any kind of I would say survey, right? And you just check it out whether what is the first thing that a person carrying in the mind while taking a foreign exchange position. He would be saying that this is the cash flow risk, he would mind. Then he would be saying that the interest rate risk, then the basis risk, then the credit risk. But IFRS 9 is helping people in other ways also. Example, this is helping people to rebalance your derivative to exposure, or derivative to hedged item, or hedged derivative to hedged item, which is rebalancing the hedging ratio. All those people, those who are watching us, if you are thinking that this rebalancing is what I'm talking, that IFRS 9 will allow you to change the figures, no. Take a simple example. Let us take a company called Cognizant. It's a big IT company with a top line of $13.5 billion. And Cognizant is an IT company who is taking more than 7-year hedges in India. Everybody know that. I'm talking about Cognizant India. Assuming the hedge position Cognizant is hedging is say 5.3 billion. And please note that in this hedge position I have marked asterisk. There is no freestanding hedges. Freestanding hedges means the hedges which are taken without any exposure, which is FV, which is fair value through P&L, right? But there is no freestanding hedges. There is no, because in freestanding hedges there is no OCI. And the total exposure which Cognizant is having is of course $13.5 billion. So if I take hedge ratio, which is hedge by exposure, which is 5.3 to 13.5, which is less than 50%, without using calculator, I am assuming that this is 48% without using calculator. Now please note carefully that I am not here discussing whether it is a forward contract or an option contract or interest rate swap, or it is a what kind, or a currency swap, or an exotic derivative, or a structured derivative. I'm not here discussing that. I'm only here discussing that which is a hedge ratio. Now the point of contention is, what would, if the economic relation, if any of these three would happen, the risk management objective while taking this hedging change in the economic relationship between these two variables, which is exposure to hedge, and impact of the credit risk. Majority of the times, the discontinuation of the hedge program, the first thing which coming in the mind of a corporate treasurer or any or the head of an accounting domain is that whether the economic relationship between the hedging item and that stays or not. But I tend to disagree with this. I tend to disagree only because nowadays credit risk is very important. Like if you look at, go to Europe, PIGS, Portugal, Italy, Ireland, Greece, South Africa, and the list is very long. PIGS is just an acronym. There are many economies of this globe which are facing the credit risk. In fact, there are many economies in Europe. From if they will go to their parent is going to ask the hefty collateral. Credit risk is the biggest risk. One risk which is slowly emerging up, which is basis risk. Federal Reserve rose an interest rate 2 weeks ago. You all must be thinking that in the video of IFRS 9, why I am discussing Federal Reserve. Federal Reserve rising of rates and giving a guidance that at least 2 more hikes is there in the future is giving a sense that the basis risk, which is the risk of the floating interest rate, would grow. So there are 3 major reasons why the hedge relationship between these two, which is derivative to exposure or derivative to or in simplistic term hedged to hedged item will impact. Number 1, which is risk management objective. Number 2, change in the economic relationship. Number 3, change in the credit risk. I am not, when I was acting at a corporate treasurer, I was not orthodox, neither I am today. In my personal opinion, these change in the economic relationships will of course matter, but the most important things which matter is credit risk and the basis risk. So all those corporate treasurers, those who are watching us and they have IFRS 9 in place, or they are looking to have IFRS 9 in place, they must be make sure that when they will go for the hedged documentation under hedge accounting, and hedge documentation is written, it is not a verbal stuff which we are talking about. When they will go for a hedge documentation, then they have to be serious about it, because there might be a requirement of a rebalancing, and if it would be a rebalance, then it will move towards, which is technically known as reclassification adjustment. And I am not referring to a technical definition of the reclassification adjustment whereby it will come to P&L once it is mature. I am referring to a different definition of the reclassification adjustment, which happens because of the derecognition of either hedged item or exposure, and it will surely impact, could be both sides. If I draw P&L here, it might come to the debit side, it might come to the credit side, you don't know. And it would, in that sense, would impact one thing which is known as EPS, which is earning per share. So this is what the video wanted to talk about, which is hedge accounting, rebalancing the hedge ratio. And believe me, as soon as we will find a lot of people who move towards IFRS 9, a lot of countries which are moving towards IFRS 9, and slowly you will make sense that media and everybody is talking about rebalancing the hedge ratio. This is for the today's video. If you have any requirement pertaining to IFRS 9, you are looking for any training in IFRS 9, you are looking for IFRS 9 implementation, you can contact us. Our website is www.treasuryconsulting.in. Our mobile number is 9899242978, and my Skype ID is Rahul5327. My email ID is rahul.magan@treasuryconsulting.in. You're always welcome to contact us. Before writing up this video, let me remind you that we are coming up our fixed income portal. But there is a small change in the fixed income portal what we are doing. The change is not for the wrong reason, change is for the right reason. Now rather than launching one portal, we are launching two portals in one, two in one. So what are we doing? There are a lot of videos which we have about carry trades on our YouTube channel. We are bringing all the functionality of the carry trades in our portal, which I know is very technical, requires a lot of effort, but nonetheless we are ready for it. We would have all requirements of the carry trade in our portal. With this, we thank you very much. If you have any requirement, please come to us. And don't forget that we are now amongst limited company in Asia, those who are offering the auto download of our training courses from our website. So if you go to our website, you refer our section, training section, you can directly download our courses, and we are expanding our training section. Maybe in the next 20 days, you will see another two tabs, which is corporate training and executive training. With this, thank you very much and have a wonderful time ahead.